After the recent move, spread product makes sense. We're less favorable on government bonds at this point in time. The market's, again, doubting the resilience of growth. And while we believe financial conditions are going to tighten as a result of this latest episode in banking, the market, again, is assuming that growth is going to be quite poor, and that spreads, the repricing of spreads, has made them more attractive here in the near term.
Do you really think you're getting paid enough bang for the buck? I mean, so the trouble is, I've got a horrible feeling, and you are of a longer-term vintage, but I've got, not as old as Jeff and I, I'm sure, but there's a lot of investors out there now who go, oh my God, look, I can get 5% on this corporate bet. Oh my God, have you seen high yield? They never heard of the word junk. Have you seen this high yield? You can get 9%. Well, actually, if they look at history, that high yield can go a hell of a lot higher than 8-9%. So do you think, yes, I hear what you're saying, but given the fact where inflation is, given the fact where interest rates are you really getting paid enough to own this corporate paper?
So high yield, particularly in the U.S., is a lot different than what it was when we grew up with high yield, right? This is not Drexel Burnham high yield. This is
my milking, right?
Yeah, exactly. So you think about half the high yield index is double B. And then you think about the oil price, and you think about some of the upgrade candidates that are in high yield.
Is double B or should be double B?
Is double B.
Right.
So like Occidental, for example, is one name that might be, moving to investment grade, right? And so, it's things like that make us a bit more comfortable. The other thing is with high yield is that they've done a really good job of terming out their debt. So so that's another piece of the equation that helps with these companies.
Okay, so you gave us an example of a double B there, which is maybe going to IG, but I'm going to raise the question again. There's an awful lot of people who still question the agency's ability to correctly gauge the risks attached to, let's say, that part of the world, the double B. I mean, you've given us an example of someone's going to credit to investment grade, but there's a hell of a lot who perhaps should be, dare I say it, a notch or two lower.
No, that's certainly the case. I mean, look, the credit agencies in general have not had the greatest reputation in the world when it comes to identifying some of these situations. But that's why, again, we do our own work on these names. We view that the companies that we're investing in are solid credits, and we constantly do it. We just had a call yesterday about re-underwriting every single name again, and we're doing that often. And this is again various stress testing that you might otherwise put things through given the uncertainty that we have going forward.
Yeah, that word uncertainty has come up a few times in your answers here, and it is notable that you've talked here about wanting to own short duration products. Which ones?
So we like spread product in short duration. So that's your IGs, your high yield, even some of your emerging markets, right? There's been great performance, for example, in local emerging markets year to date. They've outpaced the S&P year to date. So there's just a lot of different things in the short duration, and that's where you say, okay, 5%, I can go into short. Why do I got to own something for 30 years? I can own something that matures in 2 years that's yielding me 5%. And so that's the other piece of it, and part of the reason why we've also seen the large flow into money markets. Your bank's not giving you deposits. Let me go to the money market account that is going to give me yield.
Are delinquency rates going to go up?
Well, they have been going up.
It's been tame, hasn't it, really? Given the amount of rate tightening we've seen.
Exactly. And the default rates or the delinquency rates have been more of reaching what we would have considered low 5, 6, 7 years ago. But they are rising, and we continue to expect those to rise. And it really depends on the product and some of the refinancing, and that's where that tightening of financial conditions is really going to come in. We're not going to necessarily see it in the equity markets or those type of things, the traditional financial conditions. It's going to be when you go to roll your debt, the bank's going to say no.